Hey everyone. So here's a question I get all the time. Can I actually use my retirement account to buy rental properties? And I totally get why people are confused about this because most financial advisors and banks act like your only options are stocks, bonds, and mutual funds. But here's the truth. You absolutely can use your IRA to invest in real estate. And it's been legal since 1974. Mind blowing, right? Today, I'm going to walk you through exactly how this works, the tax benefits you can unlock, and most importantly, the rules you need to follow to avoid some pretty serious penalties. Stick around because by the end of this video, you'll have a better idea whether this strategy makes sense for you and how to get started if it does. So let's dive in. First of all, always good to start first things first. What we're talking about here is called a self-directed IRA. Now, if you've got an IRA with a bank or a big brokerage firm like Fidelity or Vanguard, they only let you invest in traditional stuff like stocks, bonds, ETFs, mutual funds, right? But a self-directed IRA gives you way more control. You can invest in alternative assets, and that includes real estate. We're talking single family rentals, apartment buildings, commercial buildings, raw land, even mortgage notes. Pretty much any type of real estate that you can invest in, you can do it inside of your IRA. Now, you can set this up as either a traditional pre-tax IRA or a Roth post-tax IRA. With a pre-tax self-directed IRA, like a traditional, a SEP, a simple IRA, your contributions may be tax deductible and your money grows tax deferred until you take a distribution in retirement. Now with a Roth post-tax IRA, you pay the taxes up front, but then everything grows completely tax-free. That means when you're 59 and a half and you've had the account for 5 years or more, you can take earnings, basically all that money, including all the profits from rent or sale, without having to pay a single penny in taxes. That's huge. And here's something most people don't know. This isn't some new loophole. IRAs have been allowed to invest in real estate since their creation. The reason people haven't heard about this is that traditional banks and brokerages don't want to deal with the administrative hassle of managing real estate. They'd rather keep you in stocks and bonds where everything's automated and they can control everything with a computer. So why would you want to do this? Let's talk about the tax advantages because they're pretty incredible. Imagine you buy a rental property with your IRA for $200,000. Let's make it nice round numbers. Over the years, that property generates rental income every month. Typically, if you own that property personally, you'd pay taxes on the rental income every single year, right? But when your IRA owns the property, all that rental income flows back into your IRA without being taxed. Zero taxes. Same thing with capital gains. If that property doubles in value and you sell it for $400,000, the $200,000 profit, not taxed. You don't have to worry about a 1031 exchange. It's not taxed at all as long as the money stays in your IRA. So you sell that property, all the proceeds go back into your IRA, and you're ready to do the next thing. So until you're ready to take qualified withdrawals in retirement, that is when you would either pay taxes in a pre-tax or get them tax-free in a post-tax. If you have a Roth IRA, all that growth is tax-free forever, assuming, of course, you follow the rules and wait until retirement to take it out. This means you can invest 100% of your rental income and profits immediately without losing a chunk to taxes. That compound growth over 20 to 30 years, it can be massive. Plus, Real estate gives you a tangible asset that's not tied to the stock market. So if the market tanks, your rental property still has value. It's an actual asset. You still own it, your IRA still owns it, and your tenants are still paying rent. So before you get too excited, we need to talk about the rules, because the IRS has very strict requirements. Breaking them can have severe consequences. I'm talking about losing your entire IRA's tax advantage status. So pay attention to this part. The golden rule is this: your IRA must be completely separate from you personally. Think of your IRA as a totally different person. That person owns the property, collects the rent, pays all the bills. You cannot get any personal benefit from the property until you retire and take a distribution. So what does that mean in practice? Well, you can't live in the property. You can't use it as a vacation home. You can't rent it to your kids, your parents, your spouse, anyone who is considered a prohibited person. You can't even do repairs on the property yourself. Even if you're a contractor or you have a contractor company and you want to save money, that's just not allowed. All rental income has to go directly back into your IRA. All expenses, property taxes, insurance, repairs, property management fees, all of that has to be paid from your IRA, not from your personal bank account. You can't mix the two, and never, ever commingle funds. Here's another big one. You can't buy property from or sell property to what the IRS calls disqualified persons. That includes you, your spouse, your parents, your kids, your grandkids, and any business you control. So if your mom wants to sell you her rental property and you think, oh, I'll just buy it with my IRA. Nope, that's a prohibited transaction. So what happens if you break these rules? The IRS treats your entire IRA as if you had taken it all out on January 1st of the year in which the prohibited transaction occurred. So you'd owe income taxes on the whole balance plus a 10% early withdrawal penalty if you're under 59 and a half. We're talking the possibility of tens of thousands, potentially hundreds of thousands of dollars in taxes and penalties. It's just not something you want to mess around with. So how do you actually do this? All right, if you're still with me and this sounds like something you want to explore, let me walk you through the actual process. Step 1, find an administrator who specializes in self-directed IRAs. Your regular bank or brokerage, they won't do this. You need a company that specifically handles alternative investments such as real estate. Do your research here. Look at their fees, their experience with real estate, and their customer service reviews. This is important. And it can be as simple as calling them on the phone. Do you only end up in this horrible VRU where you're going around and around and around? Or can you talk to a human? Is everything computerized, or are you going to get that personal touch? So keep that in mind. Step 2, open your account and fund it. You can do this by making contributions up to $7,500 a year for 2026 or $8,600 if you're 50 or older. Transferring money from another IRA or rolling over funds from an employer plan like a 401k, 403b, 457, even from a pension plan or an IRA annuity. Once your account is funded, then you're ready to invest. So step 3, find the right property. This is just like regular real estate investing. You want to do your due diligence. Look at the location, the rental market, the property's condition. Does it currently have a renter in it? Look for the expected cash flow. Work with a local real estate agent who knows investment properties. Step 4, Structure the purchase. If you have enough money in your IRA, you can buy the property outright. The title will be in your IRA's name. If you don't have enough, you can partner with other people or other IRAs. You can also use what's called a non-recourse loan. Now, that's a loan where the lender can only go after the property if you default, not your personal assets. Just know that if you use debt financing, you may trigger something called UBIT tax on the financed portion. So talk to a tax professional about that. Step 5, manage the property the right way. You may need to hire a professional property management company. Remember, all rental income goes to your IRA, all expenses get paid from your IRA, and you keep detailed records of everything. So, what are some challenges to consider? Let's be real for a second. The strategy isn't for everyone, and there are some challenges you should be aware of. First, real estate is illiquid. If you suddenly need cash, you can't just sell a quarter or half a house. You need to make sure your IRA has enough cash reserves for unexpected expenses, vacancies, repairs, all of that. Second, self-directed IRAs have higher fees than regular IRAs because they require more work, more hands-on work. You're looking at setup fees, annual maintenance fees, transaction fees. Make sure you factor those into your calculations. Third, if you have a traditional IRA, you'll eventually have to take required minimum distributions starting at age 73. If your IRA is mainly tied up in real estate, you might need to sell the property or have enough cash on hand to satisfy those requirements. So keep an eye on the cash flow for that property. When was the last time you checked the amount of the rent? Does it need to be raised? Have you had the same property for 6 years and you've never raised the rent? Things like that. You just have to keep an eye on them. And finally, you really need to understand real estate investing. This isn't a passive strategy where you just set it and forget it. It's not a crock pot. You need to know how to evaluate properties, understand markets, and make smart investment decisions. So, is this right for you? So, should you do this? Here's my take. This strategy makes sense if you have real estate knowledge, if you have a decent amount saved in your IRA, if you're comfortable with real estate as an investment, and if you're looking for a long-term wealth building strategy with tax advantages. It's probably not the best fit if you have limited IRA funds, need access to your money soon or often, want to manage the property or live in it personally, or are simply not comfortable with real estate investing. The bottom line is this. Using a retirement account to buy rental properties can be an incredibly powerful wealth building tool, especially when you consider the tax advantages. But it does require education, careful planning, and strict adherence to IRS compliance rules. So, before you do anything, talk to a tax professional who understands self-directed IRAs. Consult with a financial advisor about how this fits into your overall retirement strategy. Do your research on administrators and local real estate markets. Start small if you're new to this. That's usually a good indicator. But really, the key is education. The more you know, the better decisions you'll make. Remember, this is a self-directed IRA. You make all the decisions. You just have to stay in compliance. If you do this right, you could be building serious wealth for your retirement with incredible tax advantages. If you found this video helpful, please give a thumbs up and subscribe to the channel. drop a comment below if you have questions, or if you want me to do a deeper dive on any specific aspect of self-directed IRAs. I read every single comment. And hey, if you know someone who's been thinking about investing in real estate with their retirement account, share this video with them. Let's spread the knowledge. Thanks for watching, and I'll see you in the next one. Take care. Bye-bye.